Welcome to The Weekly, your go-to roundup of the top 5 auto industry headlines of the week. If you prefer to read instead of listening, join 88,000 other auto retail professionals by subscribing to our newsletter at dealershipguide.com. This episode is brought to you by Deal Now, the safe and simple way to avoid fraud, sign documents, and instantly transact any vehicle online. To learn more, visit dealnow.com or click the link in the show notes below. Let's dive in. SUV market share sets record, but prices remain constrained. SUVs now make up 58% of vehicle sales this year, a record-breaking market share, while smaller cars have dropped to a historic low of just 19%. The catch? You guessed it, affordability. While SUV prices have risen 44% over the past 20 years to over $46,000, automakers have intentionally kept them somewhat in check so as not to alienate their core audience, families. But pressures are mounting. Even with a slight 1% drop in average vehicle prices year over year, the market remains stretched. As Jessica Caldwell, head of insights at Edmunds, said, producing the bigger vehicles that consumers desire at prices they can actually afford is an arduous task. Here's why this matters. SUVs have become the backbone of the auto market, but the long game will test manufacturers. However, stubbornly elevated car prices aren't deterring consumers, which brings me to story number 2. U.S. new vehicle sales are ramping up as the year winds down. November is shaping up to be a big month for new car sales. Analysts are projecting an annualized sales rate, or known as SAAR, of 16 to 16.5 million, up from 15.3 to 15.5 million just a year ago. Total sales could reach between 1.32 to 1.36 million vehicles, a 6.6% jump year over year. What's fueling the spike? Well, number one, more cars to sell. New vehicle inventory crossed 3 million in early November, the highest since the pandemic, and up 677,000 units from last year. 2 is bigger discounts. Incentives now make up 7.7% of the average sales price, the most since April 2021. And leasing, a major incentive driver, has climbed to 23% of retail sales. And 3, confident buyers. Post-election stability and improved consumer sentiment, up 17% year over year, are driving $49.8 billion in spending. Bottom line, auto retailers will likely end 2024 on a high note with bigger incentives, but automakers could keep MSRPs high or even raise them if tariffs come into play. And if tariffs do come into play, dealers and automakers will eat some cost, cutting into their profitability. Which brings me to story number 3. Dealer M&A heat up in Q3 despite profitability slide. The dealership buy-sell market is finding its footing as dealership profitability continues to decline from pandemic-era highs, falling 28% year over year in Q3 and 7% from Q2. Despite this, mergers and acquisitions gain momentum, with transactions rising 10% quarter over quarter. So far, 389 stores have been sold this year, down 13% from 2023, but still on track to make 2024 the 4th busiest M&A year ever. By the numbers, Blue Sky values dropped 12% from last year's all-time highs to $21.3 million on average, with declines driven by brands like Nissan and Stellantis. But brands like Toyota and Honda stayed steady. Meanwhile, Mazda saw a sharp rise in valuation due to fewer stores with higher throughput, safeguarding profitability even at a time when earnings are down almost everywhere. Here's the big picture. The industry is at an inflection point. Dealerships that align with high-performing brands and diversify revenue streams will position themselves well for the future. Speaking of Nissan, anonymous sources say the automaker is in dire straits. And that brings me to story number 4. 2 unnamed Nissan executives say the company has 12 to 14 months to survive. Nissan's financial troubles are reaching a breaking point, with profits plunging 85% in the first half of 2024, largely due to weak North American performance. According to insiders cited by the Financial Times, the automaker may have just 12 to 14 months to turn things around. Here's what's driving the news. Honda is reportedly considering taking a majority stake in Nissan. The two companies, alongside Mitsubishi, already collaborate on EV development, and Renault, a key stakeholder in Nissan, supports Honda stepping in. In the meantime, Nissan is cutting costs wherever it can. U.S. production is set to drop 17% this year, and 9,000 jobs were recently eliminated. Even so, the company has issued a profit warning, leaving investors uneasy. Bottom line, Nissan's refused to comment on the report, claiming it was speculation, but if it turns out to be true, the automaker's days could be numbered. Quick reminder, if you have a tip for our editorial team, you can always send us a scoop at insights@cardealershipguide.org. I will also put the link in the show notes below. But there's another struggling automaker, Stellantis, and they're not going to go down without a fight, which brings me to story number 5. Ram's CEO teases new midsize pickup, and the details will be coming in 2025. Ram is gearing up for a long overdue return to the midsize truck market, aiming to fill the gap between its compact Rampage and full-size Ram 1500. CEO Christine Fuel confirmed the project is moving forward, but the details, platform design, and timeline remain a mystery. The big questions: will Ram go rugged, building a body-on-frame truck to challenge the Toyota Tacoma and Ford Ranger, Or will it follow the unibody trend, targeting casual drivers with something more lifestyle focused like the Ford Maverick or Hyundai Santa Cruz? The bottom line, the midsize truck market is booming, and if priced right, Ram could hit the sweet spot for dealers and buyers alike, offering a balance of affordability and value the market is craving. That's a wrap for this week. If you found this news recap valuable, please share it with at least 3 other people, and don't forget to subscribe. It really helps us grow and create more content for you. Plus, we'd really love your feedback, and we mean it. That's the only way we can get better. You can email me, Car Dealership Guy, DM me, anonymously, not anonymously, it doesn't matter. You can reach out however you prefer to let us know what you'd like. Quick reminder, if you have any tips for me or our editorial team, you can email us at insights@cardealershipguy.org, or again, send me an anonymous DM on any social platform. We'll put this link in the show notes below as well. See you next week.